Good morning, Brad. How are you doing? Today is actually March 19th. We are sitting down with Brad and Lindsay talking at the Lender Lounge about everything real estate and mortgage. So good morning, Brad. How are you?
I'm great. I'm
Good,
great.
good.
How are you doing this morning?
I'm doing well. I'm ready for warmer weather and no allergies. That's what I'm dealing with right now.
Well, let's start out by confirming that we're recording today because we did this yesterday and we didn't record it.
I have a feeling it was so epic yesterday. So hopefully we'll be able to hit the points that we hit yesterday. But the big news, we had basically talked first about the new executive orders that were put into place by, Trump housing initiatives, and we basically talked about it being a big nothing burger. But what is your thought on what they came out with 2 days ago?
The executive orders.
Yes.
Okay, so I'll first start by saying that I did vote for Trump all three times, and I would vote for him again most likely. I do support the majority of the policies that he implements or is attempting to implement, but these housing executive orders, in my opinion, are just fluff pieces designed purely for marketing. Um, we can touch on each of the pieces there, but in my opinion, none of what he's pitching here or signing it as an executive order is actually going to really move the needle.
I don't believe so. I mean, basically, he's talking about giving community banks, more competition, allowing them to get in. He's going to talk about zoning or, initiatives. But really, I feel like those are things that are done more on a local level because every state, every city, every county has their own, building regulations. And for instance, my county, if they're working on changing the zoning laws on how large a parcel needs to be and how many dwellings can be on one parcel. A lot of people are wanting to do accessory dwelling units, and the county or cities are not going to allow it. So I feel like it's too broad of a level on the federal to say that you're going to make those changes because it really comes down to the locality where you're at. Talking about getting rid of some of the building codes, that is also going to be a local thing. And to be honest, I really did not know that community banks were out of the business. So, can you go further into that?
Well, let's start with the builders. I happen to believe that if the builders are able to save some money on their builds, they're just going to put that savings in their own pocket. I
Mhm.
don't know that is necessarily going to be a savings passed on to the consumer. That's
Yes.
my opinion. I stand
Well, and
behind it.
that's on the tariff part. If they're going to basically improve the cut corners on not only zoning, but also on the cost, with tariffs, he can, basically entice other countries that we may get lumber or something from for building, and that's going to help the builder. But like you're saying, they're not going to pass that on to the borrower. They're just going to just keep the fees, the prices up.
I think
You know,
so.
yeah. I mean, it's crazy because these things are such a high level. And another thing that we didn't get to talk about yesterday that I saw yesterday afternoon was the FHFA is going to make it easier by lowering the insurance standards on condos. And this is going to be, I think, a kicking the can down the road because what you're doing is you're basically there's a insurance thing going on where roof age is a big deal. So insurance companies do not want to pay full replacement cost on roofs that are 15 years old when they're purchased. So what they're doing is they're wanting to do ACV, which is actual cash value, and it's not full coverage if your roof, gets damaged. And so if you're going to allow ACV coverage on condos, imagine if something happens, a tornado hits, and one building needs to have the roofs replaced. What's going to happen? Because they only have ACV. Do they have gap coverage? Do they, you know, you're going to first raise the assessments on that condo association, which means HOA fees are going up. So it's kind of it's not fixing the problem. I mean, lowering costs on insurance across the board needs to happen. In Georgia, they just passed a tort reform law that's going to end up lowering costs in Georgia on insurance, just like Florida did. Florida passed that 2 years ago, and you're already seeing Florida auto insurance, I think, is going down. Home
So,
insurance will start.
well, let's hope home insurance starts coming down. I can tell you personally, from personal experience, I went to pay my auto insurance a couple months ago, and it said I owed $8, and I was like, well, that's not possible. I pay, 250, 270 a month for my vehicles. So I'm going in to make the payment and it's $8. And I'm like, why is this only $8? So I paid it, right? I paid my $8. And I just happened to do the little online chat thing. And the lady was kind enough to confirm that the the things that they tried to implement a couple of years ago finally have caught up. And I got like a $1,500 rebate from
Wow.
the insurance company. So I don't have to make an insurance premium payment on my car insurance until May.
Nice.
Yeah, it
That's a
was
nice little surprise.
well, to be fair, I've been paying prior to this policy period, I was paying like almost $600 a month for three vehicles.
Wow.
Florida car insurance is out of control.
Yeah.
My
But
homeowner's insurance went from when I bought my home about $1,800 a year. Now it's about $7,000 a year for home insurance, and I'm not in
right.
a flood zone. I'm really out of the path of most hurricanes. I'm inland, but regardless, insurance is expensive. Regarding the condos, I feel like they are kicking the can down the road, but insurance is always a gamble anyway.
Hmm.
Um, I don't hate that for condos because there are a lot of times where you can't get a condo approved because the insurance company doesn't have adequate coverage on the roofing system for the condo development. This is going to open up a lot of additional opportunities for people to purchase condos. And we've talked about condos. I'm not a fan
Yeah.
typically of people buying condos, but there are people that love them, and we have to be in a position to finance them.
Well,
Um,
and the fear for me is that it's the typical condo issue. When I have someone who buys a condo, they typically will get tired of owning it because of all the HOA fee raises, those kinds of things. So, to have a surprise where, we're going to have a special assessment because we need to replace the roofs and we're only covered for this and we need to cover this. They are going to also lower that master insurance deductible. I don't know. Previously, it was like a calculation of 5%, but that's going to also be included in that. But back to these executive orders. I mean, you know, real estate runs around 60 to 70% of the economy. It controls a lot of things, and with rates going up and all these nothing burgers that the current administration, and believe me, I love him, I love the administration, I voted for it, but this to me is disappointing. And I feel like if you or I could go up there and speak our word and talk about maybe getting rid of capital gains taxes is holding people a lot of people back. Maybe amortization of mortgages, change the way they're structured. And there's a lot of things that you and I have thrown out that are better ideas than what this administration has thrown out.
yeah, for everybody out there that thinks Orange Man is bad and you've got negative things to say about Trump and you want to use the most obscure arguments, you don't need to do that. You can look right at these executive orders and do a
Well,
little
for
bit of
this,
reading. And
right.
you can totally say, this is all it's sort of just empty air we're talking about here. There's nothing in that executive order, in my opinion, either one of them that is going to help the housing economy. Let's talk about the community banks. We brought that up a little while ago. I've worked at a community bank. Community banks typically lend as correspondent lenders. And what that means is the bank is going to lend its own money and then they're going to turn around and sell that mortgage to a larger institution, Mr. Cooper, Newrez, PennyMac, used to be Chase would buy a lot of mortgages. I think maybe they still do buy some, but the community banks that have left the market probably aren't coming back just because they're going to have easier guidelines as far as what their reserve assets need to be to lend. Most of those
Right.
banks are out of practice. They're out of the space. They're not coming back into the space, regardless of the regulatory environment. I don't think there's going to be more competition as a result of this. I don't think it's going to lower rates. Banks are not, mortgage companies and banks are not really lowering rates to compete with one another at the levels that they have in the past. I really firmly believe that we're in a weird place in the mortgage industry anyway, where we don't really know what is going to move the needle outside of Federal Reserve rate cuts. And uh, that's a whole nother problem that we can address. Or
Exactly. I mean, these community banks that got out, they're not going to get back in. I agree with that. There's benefits that big banks have over all of us, and we're a correspondent lender here at Alcova. So we lend our own money and then we transfer servicing to our servicer or one of our servicers that we work with. But the big banks do get the housing grants, the large funds, but it does give us the ability to lend on community lending products, which basically end up giving the person a lower rate or a lender credit in some cases, depending on how you want to structure the loan. And that can be very helpful. And it's basically, you know, money set aside for people buying in a certain area, and that is paid for by federal taxpayer money through the federal government to entice people to buy in those areas. And I don't see profitability on loans getting better. So those that got out, I don't see this, bringing them running back. You know, you can go more into that strategy that I was talking about.
I think you will see some community banks possibly come back into the fold, but most community banks are not wanting to service their own loans.
Hmm.
They don't have the infrastructure, the technology, or the desire to service the loans. Even a company like ours that's becoming more of a medium-sized mortgage company, we just sold most of our servicing rights on the loans that were being serviced. There's good money to be made there, but there's also a lot of headaches that come with servicing loans.
Hmm.
So community banks, I don't think are going to be very impacted by this. That's just my opinion. I'm just a guy with an opinion on that. But
I agree. I agree. One of the things you brought up yesterday, and I'm looking back at my notes because, again, we tried to record this and we weren't able to. But one of the things that you brought up yesterday was the ability for buyers to roll costs in. So, talk about that. That was one of the things that you thought.
I think that would help a lot of markets. There are some markets in the country. The Virginia Beach, Hampton Roads market is one of those markets. Still very much a seller's market. Many people have the ability from a credit standpoint to be approved for a loan, but they don't have the funding needed to cover both their down payment and their closing costs. So if you can't get a seller to pay your closing costs and you don't have the means to come up with the closing costs money, you're not going to be in a position to buy a home, or you're going to certainly be limited on your options.
Right.
So I feel like if we opened up an avenue or multiple avenues where people can finance their closing costs, a lot of people think that they can. I get calls all the time where people assume they can finance the cost or have questions about it.
Hmm.
If people are asking about it, that's a problem that needs to be solved.
Yes.
So why don't we figure out a comfortable way in the lending world to solve it? Certainly, there's risk involved with lending more than a home is worth. But in a market like we're in, where values seem to be appreciating, seem to be
Appreciate.
I'm going to go back on that. So in a market where we feel like everything's appreciating or everything is appreciating, we have less risk in maybe extending additional credit for those things.
I
Um,
agree. I
there are
mean,
some, sorry, go ahead.
I was going to say USDA is the only loan right now that you really truly can roll in closing costs. But by the time you know that that's possible, the appraisal is already in, the contract was already written. So unless you had, maybe the buyer splitting some costs and the seller splitting costs, the caveat is that if the house appraises more than the purchase price, USDA allows you to roll in the closing cost up to 3% up to that, actual appraised value instead of using the sales price. A lot of people think that you can do that. And, I've gotten calls thinking that they can get cash back and take a loan out for more because the house is worth more, but they're going to buy it at a cheaper price. Oh, I can get that cash back. No, that's not allowed. But being able to roll in the closing cost on a USDA, it's kind of backwards, but it can be helpful if, the borrower wants to bring less money. That would be helpful if we could do that with a 3% down client on a conventional or a 3.5% FHA. Because oftentimes when you are pairing some kind of down payment assistance, nothing in this life is truly free. So these programs may cost money or they're silent second mortgages that sit until you sell or refinance the home, which can hinder you from refinancing if the rates drop. Those, I they can be a patch for some, but for a lot of people, they just don't hit the mark. And, in Georgia, we don't really have a ton of true grants. We have Georgia Dream, that is, 10 or 12 and a half, 12,500. And, you have income limits, you have credit score limits, you have debt to income ratio limits, and the amount of money for the median sales price in Metro Atlanta versus the median income, you almost have to be, much better borrower than, to fit into that box. So for the ability, if somebody has 3% down, but now they need to roll in closing costs, that would be an excellent idea. We're appreciating at rates of 3 to 7% in this area in Metro Atlanta, and I'm licensed in 10 states. Um, you know, it's pretty much appreciating everywhere. Some
There are
condos.
there are a couple of programs, at least in Virginia, where you can finance a very small portion of your closing costs on FHA or conventional financing, but it's not enough to really help, and the rates on that are typically higher.
Well, and
There,
I forgot to say, the way that we usually have people roll it in is you just raise the sales price, so that goes into, hey, if the seller wants 300 and they're asking 300 and you need $10,000, usually what they'll do is they'll offer 310 and have the seller pay 10,000. That way the seller's still netting what they want and the buyer's getting the 10,000. That doesn't always work. Sometimes the appraisal doesn't come in, and those are the situations that we would absolutely utilize being able to roll those in.
that's a
Go ahead.
great point. That strategy does work sometimes, but the home has to be worth enough to appraise, and you have to have the seller's cooperation on that. And not all sellers are going to cooperate there.
Yeah.
On the topic of financing closing costs or grants, in Virginia, the Virginia Housing Development Authority, which is a government bond program at the state level, they do have a program for military veterans. You can receive 2% of your sales price to go towards closing costs, which is amazing, but there are income caps on that. And you're also going to be tied to the rate that the Virginia Housing Program requires. And sometimes that rate is higher than the standard market rate. So that takes me to my next point. In the past, we have had the ability to just issue a higher interest rate and give closing cost credit in relation or correlation to what the rate is. But in
Mhm.
today's mortgage market, there aren't any options to do that. You have typically your rate that's without points, and then you have your rate with points, and maybe you have a rate that's way higher that will give you a small credit, but it's not worth taking that much higher rate for a small credit.
Right.
I remember doing loans, 8, 10 years ago where you could raise the rate a half a point and give them back 2 or 3% in
Well, and
closing cost credits.
yep, and that's where I came from, a no closing cost shop. I spent a lot of my initial days at Lennox Financial, and we did no closing costs. So I had clients that rode the rates down from 7.25 all the way down into the threes because every time we saw a benefit, when you're not spending $4,000, 5,000 in closing costs, there's no barrier to refinancing. And in states like Florida that have higher closing costs, in Georgia, it is a little bit easier. If I have a $400,000 loan amount and I know that my closing costs are 4,500, I can often find a rate that's going to pay one and then basically quote them a no closing cost or a cost. We can also work it out where we do a shared cost, where I give you a little chunk of money to go towards the closing cost, but can't pay all of it. Those days during, like, especially when COVID, when the rates were so low, they were not. That spread was so thin. And if you have a higher cost state or you have a marginal credit score or there's some caveat to the pricing, it could be a very, very tight spread of like 75 basis points. So you could be looking at a cost rate of 6 and then a no cost rate of 7.25. It could be that high. But, for the most part, especially on refinances right now. People who bought 3 years ago who have a little bit of equity, their credit scores have gone up, they're doing better. I'm quoting a no cost and a cost if it makes sense and letting them decide which one do you want to do. Because if we bank on these rates continuing to drop, which the last couple of days have been pretty rough, but we are in a downward trend on rates. When I started in this business, we were at around 7.25, and we just hit the sevens, in the last year. So we're coming back down off of that high. And my advice is let's do a no closing cost because all we have to do is wait 6 payments and then we can refinance again. And, there's no cost of doing it. So there's really nothing invested. So it's a no brainer.
I'll say this about refinancing right now. I'm receiving calls daily, more than one a day, from past clients and new potential clients asking or inquiring about refinancing because they received something in the mail that says they can get a 4.5% or a 5%.
Hmm.
Those rates that are being advertised through the mail or through a stranger calling you are heavily tied to excessive closing costs, if they can even deliver on those rates. Everything that I'm pricing out right now for refinances to me don't make sense. And I want to do loans, I want to write refinance business, but I just told my team 2 days ago, like, don't plan on closing any refinances for a couple of months because rates aren't there. You should not be advising your clients to refinance right now unless they have a dire need. I've turned a lot of my clients that need cash for debt reduction or consolidation. I've turned to a home equity line as a temporary band-aid to pay those things off because the primary mortgage rates that they have are just too low to
Yep.
justify refinancing an entire mortgage. So that'll bring us to Jerome Powell. Yesterday, before he spoke, we did our conversation, um, and I said he's going to come out gloom and doom and tank the market and say things that maybe are true or maybe they're not true, but he's
Well,
going to go out there and do whatever he can to politically wreck the trajectory of where rates were headed, and that's exactly what he did.
he
And he'll keep.
finished it. He finished his statement, and we were down 9. By the time he answered the Q&As, we were down 42. So it was like I kept wondering, like, did they put these people up to these questions because it just keeps getting worse. Like he just, and he's blaming Trump. And I knew that he was going to do that because he's out in May. So I figured that it would happen. I honestly did not expect, the oil thing in Qatar overnight to happen, which has now exacerbated the worsening from yesterday that we saw after the Fed meeting. So, I do see that oil is, or the 10-year Treasury is following oil right now. As oil prices go up, we probably are going to see the 10-year go up. But we were just at 3.95 on the 10-year, less than a
Look,
month.
the Federal Reserve doesn't care about the American people. They only care about their own interests. And
Exactly.
at the end of the day, things are not going to improve at the Federal Reserve until there is a politically friendly ally in there. You can say what you want about that. But once the new guy steps in, they're going to cut rates. Rates are going to improve. And I think going into the third and fourth quarter of this year, you will see those mortgage rates drop off to levels that make sense for a refinance.
Well, and
Um,
I think, a lot of, I've heard a lot of people in the industry talk about, when you do lower the federal funds rate, which does not control mortgage rates, um, it can be an inflationary measure that will drive mortgage rates higher. So, but my thought is that some of these inflation numbers and the employment numbers, everything has been so skewed and not really reported properly that, and when you take things out of CPI, when you're not counting shelter and housing, or what is it? Housing and there's another one, food, housing and food that you take out of. I mean, we saw the highest inflation rates in rents and groceries. So I feel like we can definitely come down on our federal funds rate and still have rates in the fives. I do believe it is possible. What do you think?
totally.
Yeah.
We've seen lower rates in much worse circumstances. I don't think that mortgage interest rates should be tied to some of the things that they're tied to. We're
Yeah.
not in a true competitive environment, in my opinion, and I don't know that we ever will be in terms of banks competing against banks for the lowest rate. That happens on a small scale, but the reality is rates are all derived from the same place. Companies are getting whatever it is they can sell. I have a client that called me for a refinance, a longtime client, and it's a large loan. I really wanted to obviously do the loan, but I couldn't find a sensible way to make the numbers work to where it really made sense to do it now versus waiting a couple of months to see if rates improve.
Right.
And he got a call from somebody else, and that person quoted a rate that is much lower. We talked about that, and that person started off their sales pitch at 7.25,
Wow.
which was not really any different than what the client already had on this property. And all of a sudden, after the client said, "No, I'm not interested in that. That doesn't make any sense at all. That was much higher than what I presented him with." That lender came back and offered a 5% rate with some points on a vacation home.
Oh my
Um,
gosh, that's not even possible.
I don't think it's possible either. So this
You wouldn't
client's
be able
pretty,
to close it with that many points to buy it from 7.25 to 5,
it
unless it's an
would,
arm.
it didn't appear to be an arm. I saw a loan estimate. It looked like it was a legit loan estimate, but in looking at the numbers, that loan is something you'd have to pay to do,
Well,
in my
and here,
opinion.
yeah. Well, and that brings up another point that, we talked about the builders not passing the savings on, and you got the guy who got quoted 7.25, and then they came back at 5. I ended up, I worked, a lot of us put our blood, sweat, and tears into getting pre-approvals done, to dot our I's, cross our T's, so that we can make sure that there's going to be no headaches. But I had a client who was sent to me from a realtor, and they wanted new construction, but they were trying to get $5,000 out of him without getting him pre-approved. but would not take anybody else's pre-approval. I took a look, knew that there was a dispute on the credit report that was going to have to be removed to be able to go to that price range. So I got the dispute removed, repulled credit. We all know how expensive that is. Got verifications of employment. We also know how expensive those are. And as a branch, we are paying for those ourselves. And, I want the best for the client. But basically, the builder came back. He had gone under contract on a resale home, and the roof was in really bad shape. And they were selling it as is. So he kind of got a bad taste and backed out of that contract in time. He was silent for a couple of days. And then over the weekend, I got a text from the realtor, and she said, "You were amazing as usual." But the builder came back and offered him $40,000 off the price and $12,000 in closing costs.
The moral of that story and the one that I just told is companies are going to try to squeeze as much as they can out of you as a consumer. And then when you put up a little bit of resistance, you might get their true price or their true bottom line. They're desperate to do
Well,
business.
yeah, and but that, I don't do that. You don't do that.
No.
It's unscrupulous people who are out there, and why did the builder not want to give him $40,000 off the price to begin with? That would have made his debt to income ratio lower. That would have been a better deal. They're buying down the rate. I mean, it's a better deal for him. Obviously, they're building those incentives into the price of the home. So I pray that he does not have to sell that home in the next couple of years, because usually with new construction, by the time they build in all the incentives, all the closing costs, everything that they're paying for you, you are borrowing more than that house is going to appraise for in the next couple of years, because now it's not being compared to those new builds that are just like it. It's being compared as a resale. And that's what a lot of people don't understand. They want that fresh new property, but they don't understand that it comes with, risk. It also comes with the fact that the builds just are not the quality that they were. Big box builders are building them as fast as they can. They are getting lawsuits left and right for, shoddy work. And I personally would buy a 100-year-old home faster than I would a new construction. The lumber's better, the materials are better, it's stronger. That's just my opinion, but
Homes built between the 70s and the 90s tend to have the best construction, the most scrutiny that was put into the builds. I think that the real advice that anybody needs to hear in that scenario is you should hire a professional that knows how to protect your interests. Anybody can go buy a home without help. Um, I read about that a lot, how real estate agents, are overpaid and how they don't, really do anything. I disagree with that. No, I'm biased because I'm in the industry. However, your example right there of a consumer being offered a $40,000 discount because there was some pushback, I guarantee you it was the real estate professional that pushed back on that price that got them that $40,000 reduction. The average consumer who doesn't do this every day is not going to be able to figure that out or have the instinct to figure that out.
no. And this was honestly desperation. That's what this came down to, because builders are holding on to homes longer. And had he dropped the price to what was more fair, maybe he would have had a buyer a month ago, but instead played games and gave me time to do a bunch of work on the loan, and then came back and offered him a deal too good to pass up. And I don't blame the borrower. I wish him well. And this is what we do. I mean, we are paid by the lender or investor when you close. We do not get paid up front. We're not paid hourly. We're not paid a salary. I do not know what a paid vacation is. I don't know what a paid day off is, or really a day off for that matter. But, basically, we are putting everything into it to try to get you closed. And if we don't close it, we don't make any money. So, it's our incentive to do everything in our power to get you closed, but there's a lot of people in this industry that don't know what they're doing, or they are unscrupulous and just trying to get one over on you.
Well, there is a lot of pro bono work that goes into what we do.
Oh, yeah.
Say what you want about it. There are plenty of times where you do help somebody. New construction is the great example. You help somebody get qualified, you help them get to a point where they can buy, and then they go to a new construction site and the builder forces them to use their preferred lender. And look, I've been a preferred lender for a builder over the course of my career. It's a nice advantage to have. And at the end of the day, that practice is not going to change or stop. As a consumer, you just need to know what you're getting into, and you need to make sure that you vet the costs. I do try to help, even if I've lost a client to a new construction site. I do try to help by reviewing the estimate and pointing out where things maybe could be better. And then the consumer can then take that information back to the builder's preferred lender and try to renegotiate better terms.
Yeah. And
Um,
then we can always watch for a refinance in the future for that client. And, I have found that when you're honest and upfront with them and tell them you should take that deal, that there's a level of respect and they know that, you're not just out to make the dollar, you're out to look out for their best interest. And that's what we're here for. I've helped a lot of people along the way. I, pray about it because I definitely hate to lose a client, but you know, what God has for me, He has for me, and if it's not meant to be, it's not meant to be. So I moved on and then got two new applications the same day. So that's the way it works. And something else that we talked about that I just touched on was buy downs. And, one thing is doing a buy down at closing to buy down your rate. That is a discount point. But there's another thing that is used sometimes to help with payments is doing a temporary buy down, which I think that it's a really good way to not throw money away, but also get the benefit of a lower rate temporarily. So that money goes into an escrow account. And if you refinance, let's say if the rates drop, you didn't buy down the rate at closing with that one-time fee. You had the seller pay to temporarily buy the rate down. And so if you refinance in that 1 or 2 years that you've done the buy down for, you can get that money back in the escrow refund versus throwing the money away, especially like we said, when the rates are dropping, you really don't want to pay points because if you plan on, not being there, it's even less, it makes less sense. But if you plan on being there, wait until it's the right time because the rates are not at the lowest yet. And especially after, the conflict in Iran, oil prices, what the Fed did yesterday, Mr. Powell, just not a good time, but we will come out of this, and we're definitely better than we were this time last year. I think we're about 5/8 or 3/4 better than we were a year ago this time.
Rates are
Yep.
certainly better than they were last year.
Yeah,
Let's talk about what a temporary buy down is and how you get one.
yeah,
First, to point out that a temporary buy down is not available on every type of loan or every program. You're not always going to be able to do that. Second thing is you have to have the seller's cooperation and participation. You actually have a form that the seller has to sign as part of the contract. And the way it works is, let's say your traditional rate is going to be 6.25, or we'll just say 6.5, because that's more realistic with where today's market is on a conventional loan. You're at 6.5%. That's what the rate is supposed to be. A temporary buy down, depending on what type you get, is going to give you a lower rate for the first 2 years, sometimes 3 years, depending on the program. Let's just say it's a 2 year buy down. Your rate would start at 4.5 year
mhm.
one. Year two, it goes to 5.5. And then after year two, it's 6.5 for the remainder of the duration of your loan. The way that the temporary buy down works is we, as the lender, calculate what that payment differential is from the 4.5 to the 6.5, that 2% rate difference. We figure out how much that is monthly. And then we figure out the same with the 5.5 to the 6.5. And then we add up all that payment savings for 2 years and we come up with what that number is. And then we ask the seller to pay it. Now,
Hmm.
it's also important to point out that the seller can only contribute so much in closing costs, depending on what type of loan you're getting and how much money you're putting down, which is something that a lot of people aren't aware of. If you're just
Hmm.
doing a 5% down conventional loan, you can only get 3% in seller concessions. So if you're doing a temporary rate buy down, that's going to eat up a big chunk of that 3%, a good portion of it. Um, you're not going to have enough to cover the rest of your closing costs. So
Right.
there are a lot of things that factor in that you need to figure out or have your professionals that are working with you figure out. I don't typically pitch the temporary buy downs. If it's brought to me, great, we talk about it. But I think those are great programs if you have a seller that has the ability to cooperate and cover those costs, particularly on a government loan where you can get 6% in seller paid closing costs. But
That's what I do them, I did several of them on was government loans, and it was because they had a large credit, and it was, okay, how are we going to use this? Okay, we're going to pay the closing costs, we're going to do the temporary buy down, and then pay some of your escrow, and you're bringing a lot less money.
if you're a home seller that's having a tough time getting your home sold, that is a great thing that you can introduce to the equation. I would call it a marketing play, but if you're willing to give up some of that equity on a house that you're having trouble selling anyway,
Don't drop
that
the price.
don't drop the price, give a temporary rate reduction.
Hmm.
That will save somebody hundreds of dollars a month for a couple of years. That may be what gets your home sold.
Yep.
Uh, that
Because dropping the price is not really going to change the payment that much versus if you
correct.
offer 10,000 for a seller paid buy down and that can pay for a 2-year buy down, that is going to be a whole lot more beneficial to the buyer than lowering the price. And it's also going to benefit the community because you're not selling for bottom dollar. I mean, I've got a townhome in a very desirable area, but this is an older neighborhood, and a lot of those people bought those townhomes when the prices were around 150. Now the prices are, 390, well, anywhere from 350 to 400. But because they have been sitting for longer, these people can afford to drop them down to 320 and get rid of them. So now we're trying to get ready to refinance. And, we're still on the sidelines waiting for it. But I'm also watching the values because the home values have dropped over there. And what she paid 365 for is now showing comps of like 360, 365. So because of those sales in the winter, it brought down her value. But values are always cyclical. How values are even derived is we basically any valuation models are typically built on a comparable analysis. So it's going to look back 6 to 12 months and find the closest, best comps that have sold. Well, if all your neighbors bought in 1985 and they only owe 50 grand and they're all selling for 300 when the neighborhood really should be going for 380, that is going to hurt until those people start lifting the prices back up. And I believe that lower rates are going to keep those prices steady and not hurt those that have recently bought into those established neighborhoods.
Sure. Well, with where rates are currently, I'm seeing that for every $50,000 in price change, you're only really changing the payment by about $300, give or take a few dollars. So when you're a home seller and you're thinking about price, or if you're a home buyer thinking about price, and price is always important, but people buy homes based on the monthly payment. So as a
Hmm.
home seller, dropping your price, which does hurt you as a home seller, dropping your price 50 grand only changes a payment $300.
Yeah.
And it hurts you $50,000. Hurts the market value of the other surrounding real estate $50,000. But if you're able to do a temporary buy down, that may cost 5 grand, 8 grand, 6 grand,
Even if it
somewhere in
costs
there.
20 grand, it's still better.
Correct. And it's going to impact that payment potentially $300 or better for at least for the first year.
Mm-hmm.
So the I guess the point I'm trying to make is you have to be working with people that understand these things and know how to present them and know how to sell them and market them and use those tools effectively to get everybody what they want.
Well, and it's like I'm working with a realtor's son and daughter-in-law, and 3% is the maximum concessions. She was going to give some of her commission at closing to them as a gift. Well, that is an interested party. So, knowing how to structure that where we can gift some of that money as mom before the closing, that's not an interested party contribution. So, as long as mom has the money to front, as a gift, we give less money at closing. Bada bing, bada boom. We're not above three. We're good to go. Those are things that people who don't do this every day are going to miss. That thing's going to get all the way to closing, and then there's going to be a problem because there's going to be too much in interested party contributions, and they're going to send it back to underwriting. It definitely makes a difference who you work with and also who you list with. It's a startling statistic. A lot of people don't know this, and I've brought it up several times that how many is it, like 75% of the realtors did not close one transaction last year?
Something
There's
like
only
that.
25% that closed one transaction. So to me, it does matter who you work with, extremely important, because if you work with somebody who is not closing deals, good luck. They probably don't know what the guidelines are, you know?
I read a lot online comments of people commentary. You don't need to hire somebody, you don't need a realtor, you don't need uh any loan officer will do. I disagree with that just based on my own experiences working with AI and seeing what the competition does out there. There are a lot of do-it-yourselfers out there, and for those of you that are do-it-yourselfers, great. You're smart, you know what to look for, you know what to do. Maybe you have experience doing this from prior transactions that you've done. But with that said, you are not the only variable in a transaction. The most comical thing that I read, uh, and this is more directed towards real estate professionals, you people, some people think that you don't need a real estate agent to buy a home, which is totally true, but they completely devalue what the real estate agent brings to the table. Um, they sure you as a consumer can buy a house without a real estate professional. You know what to do, you know who to call, you know how much to offer. The variable that you have no control over is the other party to the transaction. If you can buy a house without a real estate agent, great. But you have no idea what you're getting into with that seller.
Yep.
That seller may not be as equipped as you are to address a transaction. So you may never get to the closing table with all the knowledge you have as a home buyer without representation. You may never close because the seller has no idea how to get you there.
Or better
So
yet, be like the one deal that I did that they insisted they didn't need a realtor and they bought from a family friend. Come to find out after closing, it was discovered that the house was 12 feet onto his brother's lot, and his brother blocked them from entering their own home and put a backhoe in the driveway and refused to let them up the driveway to the easement, threatened to kill the wife and the daughter, I mean the baby. And they never got to move in, and there was no agent involved. And thank God that we got owner's title insurance, because this was a USDA loan. The seller paid all the closing costs. The seller, they paid full price or whatever. And after closing, they had to get title insurance involved. It took 2 years, 2.5 years, and it finally got wiped off their credit like it never happened. And we were able to reclose them on their first official home a couple of years ago. But I mean, that could have been easily discovered if they had been working with a realtor who was familiar and could look at those lines and be like, wait a second, this is 12 feet over. And I'm kind of surprised that even the appraiser, he was confused on the lot number, which kind of got me a little bit worried. But when he assured me that it was just the way the placement of the lots were, I was like, okay, okay. And then come to find out, yeah, crazy brother said, you're not getting in this because, I told my brother he couldn't sell and he sold anyway, so I'm not letting you on your property.
Wow.
Crazy.
A simple survey would have resolved that issue too.
Oh,
They
yeah.
would have discovered that before the property was
Well,
sold.
yeah, Georgia does not require surveys.
Yeah,
Florida
many
does.
many states don't require surveys. Technically, as a lender, we don't require a survey in Florida, but the title companies will not issue the correct title policy without a survey attached to it. So
Yep.
in Florida, you're getting a survey whether you want a survey or not. Uh,
Unless there's one on file and they feel good about it.
Last month, I closed a town. Maybe it was 2 months ago. I closed a townhome. Literally no backyard, no front yard. There's a little sidewalk. It's in Orlando. The property is close to Orlando. Very nice townhome community, but nobody has any yard. Still had to get a survey. It was 350 bucks. They still had to get a survey. There was nowhere for the surveyor to even put flags down or mark it because their property is the extent of their front porch and their back patio
Yeah.
because they're everything
Just
else
a
is common
square.
area.
Right. It's just the square right here. And I mean, that's the crazy thing. What if you're on the third floor? You're like one level of that on a 3D scale. You're not even, that's not my parcel. This is, we're all stacked. But yeah, that's crazy. That's crazy. I never thought about that.
Importance of a
Um,
survey, though, it goes to show you what a survey will do for you when you think it's just an added cost. There are important variables that go into those.
I mean, if you're buying in a neighborhood where there's plats, it's been subdivided, in order to put a fence up, you really want to get a survey unless you want to deal with a neighbor that you might fight with because they might fight over the property line. But if you are buying a house that was built on family land and subdivided into 2 acre lots from 10 acres, absolutely, I would suggest that you get a survey because this incident can happen and, if the title insurance would not have been purchased by the seller who actually went after the seller with their own money that they paid for the insurance, they would have been foreclosed. Basically, they would have just dealt with a foreclosure and waited and had to wait longer. But because of that title insurance, we were able to get that. And what ended up happening, in case anybody wants to know, is the title insurance company ended up making the family buy the property back. So that's the way they dealt with it.
Interesting.
Yeah. Crazy brother had to buy the house back. And come to
World's
find
full of.
out,
Sorry, go
yeah,
ahead.
come to find out that crazy brother also owned a taxi cab company and he parked the taxi in there. And then the cops came that night because they wouldn't let them in. And he had been shot twice before for trespassing. Not there, but somewhere else. And the cops knew him. He's well known in the area. Oh yeah, he's been shot twice. He's crazy.
Lots of crazy brothers out there.
Yeah. Yeah, so not a good time for my buyers, but now they've moved on and it's like a new life because all that stuff was erased, thank God. But yeah, these are the tales of mortgage and real estate as told by Brad and Lindsay.
There's a lot of happy endings out there, but there's definitely some nightmares I've seen.
Yeah. Hey, my husband works in divorce and adoption, and he does 90% divorces and 10% adoption, and it's the 10% adoptions that make up for the drama of the 90% divorces.
Oh my
So
gosh.
yeah, yeah. But I think we got through everything, and maybe we didn't do terrible. I think yesterday was a little bit better,
I think
but
we had more energy yesterday and we had
yeah,
more hope before
yeah.
Jerome Powell came out, but I knew he was going to wreck the news cycle and he's we talked about how he got immunity from his own potential crimes.
Well, we don't, I mean, have they taken that to the Supreme Court yet? Or, I mean,
Who knows? I
that's,
to be honest, I'm sort of moved on from that already. People
yeah,
in power tend to not really face any consequences for their actions. Um,
it's
but
amazing. We would be in jail for years for most of the things that these people get away with.
I just try to live
Oh,
my life the right way and do what I'm supposed to do. And
one final thing that we
sure,
forgot to talk about is, and I can't remember how this came up, but it was kind of interesting to me because we talked about homestead exemptions and people are trying to lower their payments right now. So, one of the things that a lot of people don't know is that a lot of states have exemptions. Some states are more built for senior citizens, disabled veterans. They will give discounts or full discounts on all of your property taxes. So you have to make sure to check with your tax assessor, tax commissioner to see if there's any deductions or exemptions that you can file for. But one thing that's changing in Georgia is it used to be that you had to file by April 1st of every year. Now they're going to give everybody a 45-day window when you get your assessment. So you'll be able to file an appeal as well as your homestead exemption so that you can basically lower the property taxes on your home. One of the things that I also recommend is based on what Brad said earlier, insurance is a crapshoot anyway. So those of you paying for $500 and $1,000 deductibles, unless you absolutely need that deductible to be that low, if God forbid something happens to your home, don't go above what you could afford, but look at a $5,000 deductible because, God forbid, hopefully nothing happens to your house after I tell you to do this. But, my deductible being 5,000 versus 1,000 saved me a lot on my yearly premium for my homeowner's insurance. So that is also a way that we can get taxes and insurance down, at least until the states do away with property taxes, hopefully. We did touch on that and how we both agree that we should only have consumption tax and not have property income tax, none of that. It would make things a lot simpler and it would make housing more affordable. Imagine if we did not have to count $400 a month in property taxes. That would
yeah,
open up housing.
property tax is a big chunk of everybody's payment. I agree. I agree with you on the deductibles. I explain this to clients as homeowners insurance being more for catastrophic circumstances. Your car insurance is a little different. You're on the road every day, you're testing other drivers, you're at risk for not just what you do behind the wheel, but what everybody else potentially could do. Your home is different. Your home is not in a situation where you're putting it at risk with the general population out there in the world. Certainly, things can happen to your home. Kids can hit, baseballs through your window.
Lightning can
Um,
strike your home.
right, but you're not going to file a homeowner's claim if a kid hits a baseball through your window. You're just
No.
not. Your deductible, even at $1,000, isn't going to pay for that window. You're filing a homeowner's claim if you've got major damage, major lightning strikes, fire, major
Tornado.
vandalism or theft,
Yeah.
tornado, things that can happen but are unlikely to happen in most scenarios. I've owned homes for 26, 27 years of my life, many homes, and I've never once filed a homeowner's claim, not one time. Knock on
Well,
wood, I'm fortunate, but car insurance is a whole different thing. I've filed plenty of car insurance claims
oh, yeah.
because your car is more susceptible to damage based on
Yep.
the the circumstances you put it in. Your house is sitting there stationary. You're not going to have nearly as many issues with your home needing an insurance claim.
Right. So raise the deductible and save on the premium so that you can get your payment down until it's time to refinance or until you're ready to move.
And if you really want to properly conserve that scenario, raise your deductible and take the payment savings from the insurance and put that aside and put that money together for deductible if something happens.
Yeah,
You know, you say,
or a fix for the repair itself instead of filing the claim because we all
yeah,
know even when they come around door to door and they tell you as a homeowner that if it's an act of God, it's a hailstorm, that your insurance cannot go up, that is a lie. That is a lie.
if
They
you
will.
even call your insurance company to ask about a claim for homeowners insurance, they will raise your premium.
Yes, that's why I always tell people call the agent. Don't call the insurance company. The actual agent can answer the question versus calling the insurance. Because once they notate, even if you say, like, it was not my fault. My mom had a tree from the neighbor's house that fell on her fence. What did she do? She called. Well, come to find out, they both had Hanover. So they both had the same insurance company, but they ended up putting notes on hers. Even though the claim was paid by them next year, her insurance went up.
Yep.
Sucks. It's the necessary evil though. I will still say, I mean, Brad and I will speak it to the ends of the days that owning a home is still more beneficial than renting. You're going to have appreciation, you're going to have equity gains versus paying your landlord's mortgage. Sure, you might not have upkeep, you don't have as high of insurance and tax costs, but you also don't have the tax benefit, and that would be capital gains, which you can walk away with up to 500,000 per couple every 2 years, and no one can tax you on it. That's the beauty of real estate.
I bought my first house when I was 19 years old, and I'll be 47 this year, and through all those years, I've bought and sold many homes. I've always, in well, all but one case, I've walked away with a profit. There was one bad buy I had, one house that I lost money on, but ultimately, I've always made money,
Yeah.
and it's allowed me to put myself in a scenario where I have a very nice home now that's more than I would be able to afford had I never owned a home. I've managed to parlay those tax-free gains on prior home sales and continually push myself to a better home. That's
Yep.
how it's done. And if you don't own a home at all and you're giving your money away in rent, I mean, certainly there are circumstances where rent makes sense and where you should not be a homeowner.
Mhm.
But those circumstances in most cases are far and few between. You should always consider owning if it's a possibility for you.
Yes, even veterans. I had veterans who didn't know if they were going to live there more than 2, 3 years. I had a guy who bought a home in 2020. He ended up making like 80 grand. I mean, that was a
Mm.
good time to buy. And he's moved on. And he put that down, and he ended up paying a lower funding fee on because he put more down on the next home. So it's always beneficial to buy. You got to have someone in your corner that knows what they're doing, and if you need anybody in Florida or Virginia, Virginia Beach, Brad is real estate in Tampa, but he does Virginia, North Carolina, and Florida, right?
For loans, yes, ma'am.
Yeah, mortgages. And then I'm in 10 states, so get with me. And if we can't help you, we can always put you in touch with someone who can. Alcova has a lot of branches across, I think we're like 28 states now. I don't know how many states we are, but we're adding states all the time.
More than I care to work in. I don't know how you
Exactly.
manage to deal with 10 different states. That's a lot of knowledge you have to do 10 states.
Well, and I'm dealing with a Kentucky buyer this morning, so I'm gonna have to put, take off my podcast hat and put on Kentucky rules hat and figure that one out. But yeah, it's been great talking to you today, Brad, and I
Always.
really appreciate you coming on. And hopefully, this market will calm down. I do truly believe we will see this market calm down, just like it went up. It can come down in the next 30 days. Could be a week. We never know. Stay tuned, guys, and we'll be back in a couple of weeks.
See you later.